All right, welcome everyone to today's webinar. I'm Ben Sutton, CPA and founder of Mazuma. We've been going at Mazuma now for about 9 years, and it's been a wonderful adventure as a small business owner myself to just learn all the ins and outs of what it takes to run a small business. Whether it's a really small business or you're a growing business, the world just never ceases to teach you, right? And to throw curveballs and give you new experiences. It's a great opportunity. I hope you're enjoying that in your journey as well in the small business world. As I mentioned, founded my Mazuma 9 years ago. I saw the opportunity to try and service more people like yourselves, and so here we are. So today, our focus is going to be making sure that you don't miss out on any deductions that you deserve. None of us want to be paying more taxes than we should be, right? And saving taxes makes a big difference a lot of times. So let's begin with defining a little bit about what is deductible and what is not as far as the IRS sees it, okay? The IRS gives this definition of a deduction as something that is ordinary and necessary to your business in order to operate. All right, so something that's ordinary would depend on your industry or your type of business. What is something that's commonly written off in your business? For example, a pet store. You know, if I own a pet store and I buy a $500 parrot to sit by the front door and say hello to everyone who walks in the door, that would be probably ordinary and a write-off for a pet store owner. However, if I bought that same parrot for my accounting firm, probably not ordinary, right? So you can kind of see the difference there. Necessary means that it's something that I need for my business, right? Something that is necessary for me to run the business. Do I need a cell phone to run my business? Absolutely. Do you need a computer to run your business? Yeah, I think there's probably no business out there these days that can run without a cell phone or a computer. Do I need a truck? Do I need employees? Do I need a speedboat, right? Or an RV to run my business? Well, it depends on your business. And I've had small business owners justify those expenses all along, and we've taken those deductions for speedboats and RVs on their tax return because that's what their business needed in order to run. Okay, so in this world of wondering what's deductible and what's not, just kind of keep these two guidelines in mind: ordinary, necessary. Okay, but let's get a little bit more specific, because we know that doesn't really help you in your specific situation. So let's talk about some more common deductions that are available to businesses. Some of the basic ones: business meals. Taking a client or a vendor out to lunch, taking a business going out to lunch with a business partner, that's always been deductible. All right. The trick there is that business meals, because the IRS kind of says, well, you're sharing that meal and part of it's benefiting you personally, you only get to write off half that cost. And up until 2018, you used to also be able to write off half of the entertainment cost. So you could go out for dinner and a movie, or dinner and a ball game, and write off half of the total cost of the ball game and the dinner. However, in 2018, entertainment got taken away, so it is no longer deductible to take a vendor or a client or an employee out to a game or a show. Next, the home office. Home office is a very commonly spoken of deduction, and it's very valuable for the small business owner, right? A lot of time for running our businesses out of our homes, and we want to be able to capture more of our home's expenses as a business deduction. Because as we all know, utilities, our internet costs, our home phone, our heating and air, those are not deductible on our taxes. unless we're using them for our business, right? So as we begin to run a business from our home, those utilities uh, costs and heating and air and maintenance costs are now able to be deducted as a business expense. All right, and there's kind of two ways to do that with the home office. There's the safe harbor method, where the IRS just asks you to define how many square feet of your home is being used to run your business, and then they say multiply that number of square feet by $5. All right, and that's kind of the safe harbor. They say if you use that method, you're basically not going to get audited. The other method is more of a direct or indirect cost method, where you take the number of square feet in your office divided by the number of square feet in your home, and let's say that's 10%, and then you multiply all your utilities and applicable expenses by 10%, and that becomes your home office deduction on your tax return. That one was abused a lot more, and therefore is kind of known as a red flag. I think that was the most commonly audited item on a small business tax return. It has been for many years. So you got to do that right if you're going to do it. Some of the other options, common rent. Now, if that's your home rent, then you can only take a portion of that, all right? Because home rent it actually falls under the home office deduction. But if you're renting space for separate space for your business, maybe a storage unit that you use to store inventory in, or if you have an office that you or an employees go to, of course, the whole thing is a deduction and can be written off. Advertising, professional fees like your Mazuma subscriptions. If you're subscribed to Mazuma's bookkeeping and tax services, those are professional fees that you can deduct on your tax return. And therefore, it's like getting a 20% discount on the fees. Travel is another one that is commonly discussed because of the personal benefits that you can get from writing off vacations, that you turn into business trips. Definitely seminars, conventions, client visits, vendor visits, all 100% write-off. So if you incur the cost of a flight or traveling there in your vehicle, any registration fees, for that seminar or that convention, all of that is going to be a write-off, and you want to capture those expenses. The nice tricky thing comes with travel when you combine a business trip with maybe some personal vacation time. And so you can actually gain a write-off still. Let's say if my father lives in Washington, D.C., and I go and visit him. However, I've got a client in Washington, D.C. also that I want to strengthen my relationship with, so I go and visit that client as well. Well, I may, if done right, I've just turned that whole trip into a write-off for my business. So certainly some benefits you can get there. Moving on to some of the other deductions that maybe aren't so straightforward, but that are often significant. All right, so let's talk about some of these that you definitely don't want to miss, because they can really make or break your tax situation. First, startup costs. Many small business owners will come and join Mazuma, and they will have started spending money on their business months and months ago, but just formed their LLC right now, right? And so, or maybe it's January right now, so they just formed their LLC in January, but they've been spending money on their business, say, since June. A lot of times, if they're doing their own tax return, they'll just forget about all that money they spent last year. Maybe they say, "Oh, it was only $1,000 or $2,000. It's not worth going back for," or maybe they don't think it can even be deducted. Well, the reality is it can, and you do not want to miss these startup cost deductions. All right, because even if you haven't started making money in your business yet, those expenses can be deducted on your personal tax return as business expenses. And that means if you've got W-2 income on your personal tax return from your job, and you've got, say, $5,000 that you've spent over the past year on this business that you're trying to start up, that maybe was just a hobby in your mind then, but now is really becoming a business. Those startup costs, those expenses that you incurred for that business, can reduce your W-2 income on this year's tax return, and that's only going to increase any refund that you're used to getting, or decrease any taxes that you have to pay. So you definitely do not want to miss those. And if you have missed them, you can go back and amend prior year tax returns to add those on. Okay. All right. So our next one that I wanted to discuss, that is often a large deduction, is the use of your vehicle, a car, in your business. All right. So if your business warrants transportation, then the use of the car becomes ordinary and necessary in your business, and you can get a lot of good deductions in relation to your car. There's two methods to take the deduction. The IRS outlines two methods, and one is mileage deduction, where they simply set a rate, which happens to be 58 cents in 2019. So 58 cents per mile that you get, or that you drive for business purposes. All right. So every mile that you drive that's related to your business activity, you get 58 cents per mile. I think it's going down by like half a cent in 2020, but essentially it's the same thing. So you're racking up these business miles all year long. And we all know that it doesn't take 58 cents in gas to drive a car, right? The cost of maintenance, the cost of insurance and stuff is supposed to be built into that 58 cent rate. Probably only cost me like 15 cents a mile to actually operate my vehicle, right? But they're factoring in other things as well. So they give you 58 cents a mile. At the end of the year, if you've driven 10,000 miles, it's almost a $6,000 tax deduction on your return. That's saving you some serious tax dollars, and you definitely don't want to miss that. The other method for deducting vehicle expenses is the actual method. Instead of using the per mile rate under the actual method, you're using actual costs. So the cost of gas, the cost of insurance, the cost of repairs and maintenance. And then you multiply all of those costs by the percentage of business use. Okay, so if I use my car 50% of the time for business, then I'm going to add up all my gas and insurance and multiply it by 50%, and that's my auto deduction, plus depreciation, which we're going to talk more about in just a minute. So typically, mileage, when you put a vehicle into your business or start using a vehicle for your business, it doesn't really matter whose name or who owns the vehicle, whether the business owns the vehicle or you own the vehicle. What matters is, what is the vehicle being used for? Okay, so if it's being used for business, it qualifies for deductions. And the question often comes up, which is better, the mileage or the actual expenses? And from what I've seen over the years, the mileage deduction is great for people who use cars for a long time. If you buy a car and you intend to keep it for 6, 7, 8 years, mileage deduction over the long run is going to give you a lot more tax savings than the actual method. The actual method, because of depreciation, gives you a nice big one-time deduction that you'll want to. So if you need a big deduction this year, you might go with the actual method. But don't forget that once you choose a method on a vehicle, it sticks. All right. So if I buy a truck and decide to go with the mileage method on that truck, that's what it's always got to be. for that truck until I buy a different vehicle. All right, so moving on now to depreciation. Uh, in the past, this was a really big deal because when you bought a vehicle or a large asset, you'd have to spread the cost out over a number of years. So if I bought a vehicle, a truck, let's say I bought a truck for $50,000 that was 100% business use. So I don't use this truck for anything except for my business. Well, the IRS would say I have to spread the cost of that truck out over 5 years for a truck, and it's 7 years for other equipment. But so for a vehicle, it's 5 years. So I would only get to deduct that $50,000 a little bit at a time over 5 years, split it up in 5 sections. Well, starting in 2018, with the most recent tax law changes, they've created this thing called bonus depreciation. And this is a major change that came in 2019, where they said you can have 100% bonus depreciation, regardless of whether the asset, the vehicle, or the equipment you're buying is new or used. You can write the whole thing off all in the first year. So there's no more spreading it out over future years. Boom, it's one big deduction. And it doesn't matter if you finance the vehicle or you pay for it all up front with cash. So you could go out and finance, we have dentists who, will go out and finance $100,000 worth of equipment. That's a $100,000 deduction this year now because of bonus depreciation. So if you've got any larger purchases, computers, cameras, equipment, furniture, vehicles like I've been talking about, you definitely want to include those as a capital asset that you're taking 100% bonus depreciation on. Right? Don't miss that one. Next one I want to touch on is retirement plans. There's a number of retirement plans out there that are great tax saving strategies for the here and now, at least. Right? All of these retirement plans that the government has set up that allow you to get deductions, they all just defer your taxes. Right? So as you put the money in now, you get a deduction. When you pull the money out later, you're paying taxes on that money. However, that's way down the road, right? So a lot of times people take advantage of these retirement plans as a way to save tax dollars now. There's two retirement plans that typically make sense for the small business owner. One is the 401k, the solo 401k for people who are running their business by themselves and don't have employees. It's the solo 401k. If you do have employees, it's the regular 401k. The other is the SEP IRA. So if you're looking at saving taxes through a retirement plan, I'd suggest looking at either one of those options. The difference is that in the 401k, you can get a lot more money in there, but you have to be running payroll for yourself in order to get the money in, or in order to get the most money in. Because with a 401k plan, there's a portion that the employee puts in, and there's a portion that the employer puts in to the 401k. The employee gets to put up to $18,000 of their own money into the into the retirement plan. Okay. The business, the employer, gets to put up to 25% of the payroll, of the gross wages that were paid to the employee. And that could be you if you're an employee of your own business, right? So you can put in 18,000 of your own and then have the business contribute 25% of whatever your salary was and put that in as well. So, and it caps out in the $50,000 to $60,000 range is how much money you can get into those things. So if you're putting that much money in there, it's going to make a big difference for your tax situation here and now. The other option that I mentioned is the SEP IRA. Works a little bit different, and you don't have to be running payroll with the SEP IRA. And there's no employee contribution. It's all employer contribution up to 25% of your profits Okay, so it's somewhat of a complex calculation, but it works out to be about 25% of, of your profit you're able to put into the SEP IRA and deduct as a business expense on your return. So let's move on now to this last one, which is probably one of my favorites because it's a beautiful thing to watch happen over and over and over again when we convert an LLC that's a profitable LLC that is making money, and we convert them to an S corporation because their entity structure warrants it. We just save them thousands of dollars of taxes just overnight. So I definitely suggest looking into your entity structure and whether or not an S corporation works for your situation. Because if you're making money, if your business is profitable, even $30,000-$40,000 a year profitable, it doesn't have to be massive profits. But if you're reaching that 30,000 or more range, or at least you think you might soon, or in the next year or two, you want to be looking at executing an S corp, being taxed as an S corp, and making that election. It's not hard to do, but what it does is it allows you to save self-employment and FICA taxes and make your tax burden a lot lower than it is. It is very significant savings. Okay, and we've got other webinars and other videos that can go into more detail for you on that. So with all of these, they're all things you don't want to miss, right? They're all things that need to be tracked and incorporated to your tax return. Otherwise, you're going to get a 1099 from maybe, from someone that paid you throughout the year. They're going to send that 1099 to you, and they're going to send the 1099 to the IRS, right? So now the IRS knows that I made $20,000 during the year, all right? So now it's the income is all reported. Now it's up to me to find and report the expenses. Okay, so that's where bookkeeping comes in, right? And that's kind of where Mazuma's service comes in. Someone needs to be reconciling your bank accounts and going through each transaction and ensuring that all of these expenses are accumulated and accounted for and grouped and reported in a way that allows you to reduce that income on your tax return and drive it down and pay less taxes. All right, and step one with that is to have a separate bank account for your business transactions. Right, it's so much easier to do bookkeeping and to get a clear vision into what your expenses, your deductions are. If all of your business transactions are in this business bank account, everything that's ordinary and necessary to running my business goes in this business bank account. And then I've got my personal bank account over here, and I'm just transferring money from the business over to the personal anytime I have profits that I can pull out. All right, so that allows an accountant or yourself or Mazuma, our accountants just really struggle when the personal and business transactions are mixed. And so having that separate bank account allows us to just focus in on what those business transactions are and have a much smoother, cleaner process for getting that information onto the tax return. Okay, so I meant to mention at the beginning that we do have, I think, the ability for you to submit questions throughout the course of the webinar. We're getting close to wrapping up now. Regardless of whether you're on this webinar or not, you can always reach Mazuma and get your questions answered. We provide tax advice to our clients and tax planning to help them put these strategies into place and ensure that they're capturing all the deductions that are available. We're looking ahead at what the tax bill might be and how to drive it down. We're, of course, also doing the bookkeeping and tax return preparation and filing for all of our clients for a flat monthly fee. All right, so if you haven't checked us out, do that. And I guess we'll move on now to any questions that have come up. All right, first one. Can you write off a home office in addition to the costs of the corporate location? Yes, you can. So, and that's a great question because, and this brings up something else having to do with travel. So you can take a home office deduction. Now, if you're a corporation and you've got a corporate location and you're an employee of your corporation and have an office at home, you should be reimbursing for those home office expenses. So the business can reimburse you for the costs you're incurring of your home, and therefore the business gets to write off the reimbursement cost that it's paying you for those reimbursements that they pay you. So definitely you can. And the other nice thing, if you are the owner of the business and you have a corporate location and a home location, that begins to open up the possibility that the miles that you travel between your home office and your corporate location are deductible. Typically, commuting costs are not deductible, but when you're traveling between two office locations, that's not commuting, it's business travel. So also look into that as a possible deduction. All right, next, what is the best way to track miles driven? This is a tough one. It has been for years, although it's gotten a lot better now that with the apps that are available. Mile IQ is an app that I've seen work well consistently. So and basically, just tracks every time you're driving, and you like swipe one direction for if it's a business travel, or swipe the other direction if it's personal, and it'll track your trips and your miles all there within the app, and then spit out a report at the end of the year with it all broken out. So check out Mile IQ. I'm sure there's other apps that are good as well. That's just one that I've seen work. All right, next, can visiting a remote employee create the write-off of a business and personal trip? Yeah, if there's a purpose for visiting that employee, if there's a need to meet, absolutely. Just kind of like I mentioned earlier with the travel thing, if you're combining business and personal, if you're conducting business at the location, then it can create a write-off for that trip. Next, can we file as an S Corp even if we were an LLC last year? Yes, you can. You're supposed to make the S Corp election by March 15th of the year that you want to be an S Corp. However, the IRS is constantly allowing us to file late S Corp elections, even if for last year. So right now, I could file an S Corp election for my LLC and ask the IRS to apply it to the 2019 tax year. Right? I do that with Form 2553 and put 2019 as the beginning date that I want it to apply. And if I've done it correctly, they will approve that application and allow me to be taxed as an S Corp in 2019. Can even go back multiple years, in fact. The thing to remember with the S Corp, we didn't get into too much detail, but there's that payroll requirement. If you haven't been running payroll, there's a possibility that the IRS will reject your application because S Corps are supposed to run payroll for the officers of the company. But it's definitely worth trying and doing anyways. It might just get approved. We've had plenty approved that haven't been running payroll as well. Okay, next question. Can a SEP be used to create a deduction that will be paid out to employees based on tenure or any variety of calculations? When you set up a SEP, you are required to have a plan document in place that determines in clear, defined ways who qualifies for SEP benefits and who doesn't. And I've seen those plans. The financial advisor guys will know this a lot better than me, but I've seen those plans stipulate that someone has to maybe work for you for a year or maybe even 2 years or something before they can begin participating in the SEP. You can't get selective with the SEP. It really has to be set standards. But I have seen those SEPs set up to where you have to work for a certain period of time before you start to get to participate in that. Okay, next question. Pulling up here. I received a bonus from the bank for opening a checking account. Does it count as income? Probably does. Depending on how big it is, you may or may not really have to worry about it. But if you've received a benefit for setting up that bank account, it's either income or it's going to decrease your bank fees expense, which has the same bottom line effect of increasing your taxable income. All right, next question. Here's a nice specific question. I registered an LLC in August of 2019, paid $800 for California franchise tax for the 2019 year. No revenue in 2019. Can I file taxes for the LLC along with my own personal income tax, or should the LLC file a separate Form 568? So if you are the only owner of your LLC, then you do not need to file a separate federal tax return. Because for federal tax purposes, single member LLCs, single owner LLCs are disregarded, and you just report the activity on Schedule C of your personal tax return. Okay, and any tax software, any good tax software out there will allow you to, as a California filer, will allow you to indicate that this is a single member LLC, and then it will generate that Form 568 for you, that LLC tax return that does need to be submitted with the California personal income tax return. So definitely you want to fill out Schedule C, even if you said you had no revenue, but you may have expenses. You've got the $800. Like I said, there's no reason you shouldn't be reporting that $800 as a business expense, even if it's the only thing. It'll decrease your taxes by a few $100s at least. So you'll report that as an expense on Schedule C of your federal tax return, and then the tax software will generate a California LLC return if you mark that it is an LLC in the tax software and not just a sole proprietorship. Okay, that's a great question, because if doing that right, marking that it is an LLC and filing the proper California LLC tax return, like you're saying, will prevent you from getting a letter from the California later saying, hey, you filed the wrong return and you owe us penalties of this. All right, next question. This is great. I love these questions because they're what you need to hear, right? I can talk about all kinds of stuff, but I love addressing exactly what you came to find out. Next one, do I need to file my personal and business LLC taxes separately? So I hope maybe I just answered that. If you are the only owner of your LLC, then it all rolls up onto your Form 1040, your federal Form 1040, with the LLC activity being reported on Schedule C. And so that's all part of the same tax return. So if you're the only owner, the answer is no. You just report it all together. If you've got more than one owner, yes, you do need to file a separate business tax return for the LLC. And that's Form 1065 if it's taxed as an LLC. And then each of the owners of that LLC will get a K1 from the 1065 that reports each owner's taxable activity in that business. Okay, next question. Let's see here. Can mileage both to and from a billable meeting be deducted? Yes, absolutely. Mileage, like I said, commuting, if you're just going from your home to work back and forth, that is not deductible. But any other travel that you go to for a business meeting would be deductible. Next one. Can you explain the 20% business tax advantage over the past couple of years and how it applies? What is a pass-through business and how do you incorporate the 20% benefit? Great question. I'm glad you brought this up. So when the new 2018 tax law came out and they reduced the corporate tax rate to 21%, right? The big business C corporation tax rates used to go up to like 35%. They reduced them down to 21% for all large or for any C corporation. Well, they said, oh great, now that we've done that, even the smaller businesses are going to be leaving the LLCs. What about, we got to give the small business something, or else they're all going to just want to convert over to a C corp. And so they created this QBI deduction, or this qualified business income deduction for pass-through entities. And these entities, these pass-through entities, are LLCs, S corporations, and even sole proprietorships are considered pass-through entities for this deduction. And basically, it's just a new 20% deduction across the board off of your profit. So if I generate, let's say I generate $50,000 of revenue, and I go through and I take all my deductions that I can get, and I'm left with $10,000 of taxable income. So I've got $50,000 of revenue, $40,000 of expenses, and then $10,000 of income. The QBI deduction will allow me to get an additional $2,000 of deduction because I had $10,000 and I get a 20% deduction just because I own a small business and generated small business income, pass-through income. All right, that deduction is not taken on the business tax return. It's actually taken on the personal tax return. So you'd want to make sure that you're getting that in there properly. But like I said, that applies to LLCs, S corps, sole proprietorships. It's a 20%, kind of simplifying it down. It's a 20% tax deduction on any profits, any taxable profits that you generate from those business activities. Okay, moving on. I'm going to grab a little drink here. Okay. With respect to the home office expenses, can you use the safe harbor $5 per square foot calculation, or can you also just have the business cover the cost of certain expenses, such as internet? Technically, you're supposed to use the $5 safe harbor if the internet is being used for personal and business use. Do I have businesses like bloggers and maybe Amazon sellers or other people who are at home, and heavily rely on their internet? Do I have them writing off 100% of their internet? Yes, all the time. And it's usually not a big enough number to really make me, to cause concern. But the appropriate way, if this internet is being used for your kids to do their homework and for you to do your business activity, then you should be doing the $5 square foot thing. So there you go. Next one, can you register your company as an S Corp for your first year, even if you're not profitable, to avoid paying the $800 to the state of California? Great question. The state of California, I believe, gives you that a first year free kind of thing. They don't make you pay that $800 in the first year if you're an S Corp. Yes, you can certainly do that. There's no harm in doing that. you set yourself up a little bit for some potential administrative uh, issues in the future, because once an S corp, the IRS is going to expect you to begin running payroll. Maybe not in your first year, but soon after, especially if the company is making money. So the S corp kind of comes with that payroll obligation, running payroll for yourself or for your employees if you're making money, which can cost easily, $800 a year in just payroll costs. But you can be an S corp from day one if you'd like. If it's a single member LLC, I would probably advise against it, because with the S corp you also have this separate tax return that has to be prepared, whereas with the single member LLC you don't have to prepare that second tax return. So you just want to be aware of the extra additional costs that could come with being an S corp, but it doesn't hurt to do that day one. Okay, next one. I was contacted earlier in May when I set up my LLC for bookkeeping and tax. I have my accounts in QuickBooks, so can you do the bookkeeping and taxes for me? Well, of course. Yeah, we can. The issue is we won't be maintaining your QuickBooks. We can migrate you off of QuickBooks onto the bookkeeping software that we use. We think it's better than QuickBooks. We'll let you be the judge, but we definitely can take over that for you. We'd be happy to. Just get back in touch with us. How important is it to keep receipts on things that I spend for my business? This is a great question, a common question. The fact of the matter is that receipts are like a safety net for if you get audited. Okay, and really, for nothing else, as long as you have a business bank account set up. If I've got a business bank account set up, and I can pull my business bank statements, and I'm looking and I see, oh yeah, here's all my business expenses. The same information that's on a receipt is on that bank statement pretty much, right? So I've got the same information, the same support for my business activity with the business bank statement as I do with the receipt. But if an audit happens and the IRS is digging through everything, they want as much documentation as they can get. So you don't need it in order to get a deduction, but you might hold on to it for safe, preserve us, giving a little more assurance that you get through an audit okay. But our clients, we do things right, and our clients rarely ever have to worry about an audit. All right, can you prepare LLC taxes for a sole prop if you have not been doing the bookkeeping until now? How about the personal taxes of the sole prop? We certainly can go back and do a whole year's worth of bookkeeping for a sole prop or an LLC. We do that all day long, right? That's our specialty. People bringing us a mess or a year's worth of transactions they don't know what to do with, and we can whip through it for them and prepare both the personal and business taxes for that. All right, next one. To be clear, you said the SEP contributions can be up to 25% of the company profits. I guess I don't understand how you then equate that money to an amount that would be paid to an employee. Good question. The calculation is so profits. The profits pertain to how much the owner can put away, right? So if I'm the owner of the business, I'm looking at profits to determine how much I can contribute, up to 25%. If in my SEP plan I choose 25% as the benefit rate, then I can put 25% of, and like I say, that's simplifying it, but up almost around 25% of my profits away for me as the owner. If I have employees also, I have to put that same rate, 25% of their salary away for them. Okay, so I hope that makes sense. So in a situation where I'm the owner and I get profits, but I have employees and they get wages through payroll is 25% of their wages and 25% of the profits for me. And that does change the fact that you have to use the same rate. Often, if you've got employees, 25% of their wage is high. So a lot of times we see with people with SEPs who have employees, the rates will be much lower than the 25%. All right, next one. Can you prepare, let's see. Can you prepare LLC taxes for a sole prop? I think we already did that one. Okay, are inventory purchases for a retail business deductible? Absolutely. If you stay underneath, I think it's like $5 million of revenue, you can just expense your inventory purchases all at once. So when you buy them, if you're using the cash method of a cash basis for filing your tax return. If you're using the accrual method for filing your tax return, which for small businesses usually is more sophisticated and not necessary, and in this case would increase your taxes. If you're using your accrual method, you can't deduct your inventory when you buy it. You can only deduct your inventory when you sell it. And so we usually don't recommend doing that. We usually recommend the cash basis method for small businesses so that you can just write off your inventory purchases as they happen. All right, next one. There's a follow-up question here to the SEP. But if the owner also receives payroll, is it 25% of wages plus profits? No. So if you're an S corp and you're on payroll as well, then it's still 25% of your wages as an employee. So if you're an employee and you've got other employees, the 25% is just based on wages and not profits. Okay. All right, next one. Can I file for an S corp if I work for myself with no employees? If so, what is the best way to file for an S corp? Absolutely. We've got many of these single owner, sole owner S corps. It's a great strategy for that. So what you do is you file a S corp election on Form 2553. You can just Google that, IRS Form 2553. You put your information on there, and you fax it in. It's easy. Don't let any lawyer or anybody charge you significant money to do that for you. We charge $50 to file an S corp election because it's such a simple process. In fact, I'm sure other services may do it for free, but it's Form 2553. You just have to be very particular and detailed and exact in filling that form out. If you miss one little dot or forget to cross a T, the IRS will send it back to you and say it's rejected because you didn't do this or that. So you want to, the deadline for making an S corp election, like I mentioned earlier, is March 15th. So if I want to be an S corp for 2020, then I need to file the Form 2553 by March 15th of 2020, and that election goes in force. I can add a little bit of explanation to the Form 2553 and make a late election and get it applied to prior years. That is certainly possible. So as soon as your Form 2553 is filed, faxed in, and they will send you a letter back approving that S corp election, and then from there you should be filing an S corp tax return instead of the LLC tax returns. Next one, another one on receipts. I think we covered receipts. I operated during 2019 as a sole proprietor in a one-man consulting business. However, filed for and received an S corp on 12/31/2019. Can I file as an S corp for all of 2019 or just going forward? it depends on what that letter said. If the letter said you are approved, it should have in the 2553 election that you filed. There was a place to put a date that you wanted the S corp election effective. So that is the date that your S corp begins, and you would need to start filing an S corp return for. It would be a little bit strange to see 12/31/2019 as the effective date. Typically, you're going back to the beginning of the year. So if your S corp election was approved for any time in 2019, then yes, you should be filing an S corp tax return for that period of time, and then you'd be filing a sole prop or single member LLC tax return as part of your 1040 Schedule C for the other period of time that you were not approved as an S corp. General practice is to try and get the S corp approved for the whole year, so that you don't have to worry about splitting the year, right, and doing two different types of tax returns. All right, next, where are we here? So what about receipts? Do I have to keep them when it's for business if they're ordinary and necessary? I hope I answered that. No, you generally do not need to keep receipts for business transactions expenses that are ordinary and necessary. For things that maybe aren't so ordinary, like if I am taking my client, if I'm doing something out of the ordinary, right? If I'm going somewhere, or I'm buying this big sign for my building, or I'm having a hard time thinking of an example, but something that isn't so ordinary, but that I feel is necessary and justified as a business expense, maybe I hold on to that receipt again, but it's only just in case of an audit. All right. And just so you're aware, audits do not happen typically to small businesses that have their bookkeeping in order and report things as the IRS is expecting to see them. It's your chances of being audited are very slim. And in fact, let you in on a little secret, the S corp is the least audited entity there is. Single member LLCs and sole props filing on Schedule C, you have a higher chance of audit, but that's primarily because people are using those and doing those who and aren't doing the bookkeeping maybe correctly, or aren't preparing the tax return correctly. IRS picks up on those things that aren't being done correctly and decides to audit you. But small businesses that have their ducks in the row and are organized and are doing things right, it's a very, very, it's less, I think it's less than 0.1% that your chance of being audited. All right. And that's even if you're not doing things right. If you're doing things right, it's almost zero, because the IRS isn't going to just audit you for fun. They don't have the resources or the personnel to do that. All right, next one. I'm sorry I'm a little bit late. Will this webinar be available for future reference? Yes, absolutely. The plan is to email it out to all the participants who registered for the webinar. Next question. For corporate tax filing, is it necessary to file joint or separate tax, being a single owner? Which is the recommended one? So if you are a C corporation, an S corporation, or an LLC that has 2 or more owners, you need to file a separate tax return for the business. Okay. If you're a sole proprietor or an LLC with only one owner, then you're only filing the personal tax return and including that activity, the business activity, on Schedule C. So C Corp, S Corp, multi-member LLC, separate business tax return, sole prop, single member LLC, all filed on the personal tax return. Okay. Oh, looks like we got a little plug here from one of our clients, from Brian. I use Mazuma and the peace of mind is invaluable. Thanks, Brian. We hope so. Next one. Also, I'm a Michigan one-man LLC bookkeeper working from home, using internet, space, and electricity and other utilities, wondering how to treat all these regarding taxes. It's my first year. The safest way to take those deductions is using the safe harbor home office deduction, $5 per square foot of home office space that is designated for the home office. The other method is taking a percentage, the ratio of your home office to the whole house, multiplying all of those expenses, the utilities, repairs, maintenance of your house, all those expenses by that ratio, and taking that as a home office deduction. You'll find that on the Schedule C worksheets that the tax software has in place for you, entering all that information. Okay, next one. Why would the IRS want to audit someone? Well, it's a good question. They want to keep people honest, but really they're looking for fraud. They're looking for people who aren't being honest on their taxes. Okay, and there's things that when you look at a tax return, someone who's experienced like myself or the IRS has computers and stuff that are monitoring, you can look and see if this person knows what they're doing or not. And it's pretty clear to tell sometimes when someone's being dishonest. And so really, we all know a tax return is just a piece of paper that I can write anything I want on. I can plug any number I want into a tax return. So it's really an on your honor system. And there's beauty in that. For those of us who are ethical and honest, it's wonderful that we don't have the IRS breathing down our necks constantly, as long as we're willing to do it right, and as long as we're willing to be honest with what we report. So they're looking for people who are being dishonest, and because that's illegal. It's illegal activity, and they should be paying more taxes than they are, and so the IRS is the enforcement arm of our government to make sure the taxes are being paid. Okay, next question. Started my LLC around August. Haven't made any profit yet, just spending on getting things going. What do I need to bring with me when it's time for taxes? So whoever's preparing your taxes is just going to want to know how much money you spent and what you spent it on. Okay, and if that's buried away in your personal bank statements, it's going to be a bit of a pain. But you need a way to list all of the transactions that you spent, where you spent money for your business, and be able to present those to an accountant or a bookkeeper or yourself if you're going to aggregate those up into categories and then place them on the tax return as a business expense. All right. What was the name of the additional 20% S Corp pass-through deduction? I call it the QBI deduction. It's qualified business income tax deduction. If you Google that or search it, you should be able to find something on it. And again, that's not just for S Corps, but it's for LLCs and sole proprietors as well. Next question. I registered an LLC in August 2019, paid the $800, no revenues. Oh, I think we covered that one already. Can I make the S Corp election to avoid paying the $800? Let's see here. Okay, I think. All right, let's cover this one real quick. With respect to the sole LLC filing for an S Corp, what are the advantages and disadvantages? So remember how I said with an S Corp, you've got a separate tax return, a business tax return to be filed. It's Form 1120S. It's the S Corp tax return if you're an S corp. If you don't make that S corp election and just stay a single member LLC, then you're reporting your LLC activity on your personal tax return, which you have to file anyways, and you don't have to worry about paying someone or you preparing and filing that separate S corp tax return for you. So that's a disadvantage to forming or electing to be taxed as an S corporation. It's the extra tax return. If you go out and pay someone to do it, it's going to be hundreds of dollars to have someone prepare that tax return for you, right? And if you don't know what you're doing, then it'd be easily screwed up and could trigger an audit. Another disadvantage to the S corp is that S corps are expected to run payroll, and that means payroll, like paying an employee and then withholding and remitting taxes to the IRS and to the state and local governments, filing quarterly payroll tax returns, filing year-end payroll tax returns and W-2s, and making sure all of the taxes that were withheld from payroll get remitted to the state and to the IRS. So that's payroll, and the IRS expects you to run payroll as soon as you become an S corp, because they want they require the owner officers of the S corporation to be compensated through payroll. You also get to be compensated through just owners' distributions, but some portion of that you have to be compensated through payroll, and so that's a bigger discussion about how you save taxes through that, and you will save taxes if you're making money as an S corp. You just want to make sure you're saving more taxes than is worth the administrative costs of filing a separate tax return and paying a payroll service, which I would always recommend paying a payroll service to manage all of that for you. Those are the two big disadvantages, the costs that come with that S corp, separate tax return and payroll. So if the tax savings exceed the costs and headache that kind of go along with those extra administrative elements, it's definitely worth doing. Whether you're the only owner and only employee, would be the only employee, or you've got other employees. We're so familiar with it. We often will recommend it if the company is making, like I said, at least $30,000 of profit in a year. Okay, I filed the 2553 last week for my LLC to be taxed as an S corporation. From October, it looks like the election date is going to be from October 31st to December 31st. If I'm waiting for approval from the IRS, can I still file my tax return as an S corp for 2019 year? Yes, I would, because it does take 4 to 6 weeks, usually, maybe 8 weeks at most, for those 2553s to get processed. But the reality is they're going to be expecting an S corp tax return from you, and so do file the S corp return, even though you're waiting for that approval. It's unlikely that they don't approve you, especially if October 31st was the beginning of your LLC. Let's see here. Although, let's see. Yeah, and you're still within the. So I said earlier that the S corp deadline was March 15th. That's assuming that like January 1st was the beginning of your year, because you can make an S corp election at the beginning of any year that your business is in operation. So it's 2.5 months from the beginning of the year, or 2.5 months from the beginning of your corporation, your LLC's existence. So if your LLC was formed on October 31st, then you're still within that 2.5 month time frame, and are able, and you're not filing late. You didn't need any extra wording or any extra letter to attach to your 2553 to ensure that they don't reject it. So you should be good to go. All right, follow up on the home office question. Will I need to post all of the items on my QuickBooks company as an expense, or wait for the tax prep before I do? Wait for the tax prep. So there's on the tax return, Schedule C has you list out all of your regular business expenses that you would have been compiling, all of these things that you would have been compiling in your income statement. So that goes on the Schedule C. And then tax software has like a separate section where you would enter the home office details. So you can go ahead and keep that separate. All right, looks like we've come to the end of our questions. So thank you very much for being here. It's been great. I love finding ways to save you money. That's really what Mazuma is about. So we're happy to do that in any way that we can. This webinar will be emailed out to all registrants and uploaded to our social media website. So if you came late or want to look back on something that we talked about, you'll be able to. We are on Facebook, Instagram, Twitter, and LinkedIn, so it should be published to all of those. We have monthly webinars that are covering topics like this or others that are applicable to you as small business owners, and then we always have question and answers at the end. So we love doing this and love getting you answers to your specific situation, regardless of whether you're a client of ours or not. You can plan on the next webinar being a Wednesday, February 12th. All right, and so for anyone here who's new to Mazuma or maybe hasn't been exposed to our service yet, I mentioned at the beginning of the webinar that we're going on our 10th year as a company, and we were built to service the small business with bookkeeping and tax needs. We do the bookkeeping, we do that detail work to ensure all your records and expenses are accounted for and compiled in a way that not only allows you to see what's going on in your business throughout the year, but saves you taxes at the end because nothing is being missed. Okay, and we do that for a small monthly fee, flat monthly fee. So our plans include the tax return, and if you're on our Business Plus plan, you of course get the business tax return and the personal tax return, which is a huge value add. I mean, for us to do the business and personal tax return just takes care of your whole situation, ensures that you're getting all the deductions, not only in the business, but on the personal side, and that it's all filed as efficiently and quickly as possible. And so that's all part of our service and our effort to support the small businesses of America. So anytime you can call us at 866-575-9100. Of course, we've got our website, mazumausa.com. If you want to get any more information, feel free to reach out to us. Thank you very much. Have a good one.